We are thrilled to be joined by John Linehan, CFA, Portfolio Manager for the U.S. Large Cap Equity Income and U.S. Select Value Strategies, and Co-Portfolio Manager for the U.S. Large Cap Value Equity Strategy in the Global Equity Division. Saum Priestley, CFA, Head of Multi-Asset Solutions North America and a Portfolio Manager in the Multi-Asset Division. Today's talk will be moderated by Caleb Fritz, CFA, Portfolio Specialist in the U.S. Equity Division. And with that, I will turn it over to Caleb to begin.
Thank you, Rex, and thank you, everybody, for having us here. It's great to be here in Atlanta and have this conversation with you. I'm going to set the stage a little bit, but you're going to hear mostly from Saum and John as we talk through this topic of beyond borders. And what kind of prompted this thinking is just kind of the way that the markets have been over the last 10 years. And I think we all know that it's been very much dominated by the U.S., right? But I think it's important to put some numbers behind that and stew on that a bit, because it is quite remarkable how strong the U.S. has been relative to other markets. S&P 500 is up 15% annualized over the last 10 years, which is a remarkable 10-year compound rate. If you compare that to the rest of the world, you have actually had pretty good returns in U.S. dollars over the last 10 years outside of the U.S., 8% or higher. And that's not bad over a long period of time, but compared to the S&P, it's obviously much less. And even within the U.S., you had this big bifurcation between value and growth, and then you also had a bifurcation within growth between tech and communication services. So it's been a very narrow market globally, where concentration of returns is really in the U.S. and in the growth side. I think it's important to note the Russell 1000 value over the last 10 years has compounded 11% return on an absolute basis. So it's a decent absolute return. Just when you compare it to the 19% return we compounded on growth, it really is worked. So that's the setup for the decade. The last year, though, has been a little different. We've seen kind of things turn on its head. Outside of the U.S., we've had better returns than the U.S. And so the question is, what is changing? Is something changing? Is the future going to be different than the past 10 years? And so that's what we're going to talk about today. I want to provide a little bit more of an introduction to the two panelists here, and I'll start with John Linehan. John is one of our chief investment officers at Rowe Price. He is a portfolio manager. He runs value portfolios for us, in particular our equity income strategy. He's one of the longest tenured value investors working today. He's been running value portfolios for over 25 years for us, so a lot of experience here today. John also sits on our asset allocation committee, so he's got a hat as an asset allocator as well as an investor in value. There's an anecdote I'd like to tell about John to give you a sense of who he actually is. He graduated out of Stanford Graduate School of Business back in 1998. And if you think about that time, a lot of his classmates went into Silicon Valley startups. And John had that option. He graduated first in his class. He could have done that. He didn't. He came back to Rowe Price, came back east, and he asked to cover value-oriented parts of the market. So I think even at that time, he was willing to be contrarian and knew who he was as an investor. Saum Priestley is someone I've known for many years, and we're really great to have Saum here. He's the head of Global Investment Solutions, Americas at Rowe Price. He's one of our portfolio managers in the multi-asset division. His role is to create solutions across different channels, distribution channels, institutional as well, and really meet the needs of our clients, and he's well suited to do that. Saum has had a great career at our firm. He came to us in 2012. He's been in the investment industry since 2006. And he had a real formative experience, like a lot of us did during the financial crisis, where he saw the rules of the world change a bit, and it reinforced his belief that diversification really matters. He went to business school, wanted to be closer to investments, and we were able to get him back in 2012, and he's really risen through the ranks. So we're fortunate to have both Saum and John here today. Saum, I want to start with you, and I'll start with the million-dollar question, which is that if you had one region around the world over the next 5 years to invest in, what would it be?
Sure. Well, first off, I'll start off by just saying thank you everyone for coming out, spending your lunch hour with us, and thank you, of course, for the Atlanta CFA Society for hosting us. So this is a tough question. I think it's a particularly tough time to be having this panel, and just the degree of difficulty in markets is high right now in general. The dispersion of potential outcomes, especially over a 5-year period, I think are very, very wide. So with that caveat, I will say the U.S. The reason I'm going with the U.S. is I still believe many of the world's best companies are here in the U.S. The innovation, projections for earnings growth are still high, profit margins are still very high. And if you look at the ROE for the S&P 500 versus the ACWI ex-US is about double right now. That said, 5 years is definitely a period where valuation matters, and we need to be cognizant of valuation. So I'm not suggesting that you just chase momentum and go U.S. large cap growth, right? I think I'm really positioning more for a broadening here, thinking about value markets, GARP stocks, some of those areas that have been sort of left behind potentially on a relative basis versus large cap growth over the last decade or so. So we can get into some of those reasons. I also feel as though the U.S. market is 70% or so, hereabouts of the API, right? So there's multiple markets in the U.S., right? And sort of a weird paradox, I feel as though you can play defense against the AI story not working out right by extending it to value. But you can also play that over 5 years we start to see the benefits of AI sort of migrate through the market and start to benefit some of those other companies that are sort of complex, human capital intensive, where they can start seeing true sort of ROI on these efforts. So I'm going to go with the U.S.
John, what are your views on this?
Yeah, I'd agree with Sam in that if you look at the fundamental setup, the U.S. market is uniquely well positioned going forward. We talked about AI, and that clearly has been a driver for the markets, but there's also other innovations in the marketplace that I think are there to transform the U.S. economy. But that being said, and Sam kind of alluded to this, as an investor, you have to balance both fundamentals and valuation. And while the fundamental light is definitely green for the U.S., I would say the valuation light is yellow, and if we squint, it might be actually pretty red. And there's some kind of commonsensical metrics that I look at that I think are really helpful. If you look at U.S. market cap as a percentage of GDP, we're in uncharted waters. It's over 350% of GDP. We've never been at those levels before. If you look at the U.S. market cap relative to the rest of the world, it's over 64%. And again, we're in uncharted waters there. If you look at valuations, we're at multi-decade highs. And I think really what it suggests, and this goes back to Sam's point, is the U.S. market right now is somewhat of a levered bet on the transformation of the U.S. economy continuing. And so if we distilled it down, I think it's somewhat of a bet on whether we are going to see the benefits of AI, not in the economy, but in the market. And if we do, I think the U.S. is going to be an extraordinary place to invest. And if we don't, I think the residual or anything else will probably do better. The reality is with the Mag 7 being over 38% of the S&P 500, if you think about the U.S. market in a more homogenous way, you really cannot escape the Mag 7 contribution to the S&P. And at least 5 of the 7 Mag 7 names are really levered to the AI bet. So I think there's some puts and takes in here. The other thing I think is, I'm a real believer in kind of over time in U.S. exceptionalism when it comes to the marketplace and when it comes to the economy. And the engine of innovation in the U.S. I think is very differentiated relative to the rest of the world. But if you look at what's going on in Europe over the last year, you're seeing German fiscal policy change dramatically. You're seeing the European economies, or European countries recognize that they're going to have to spend more on defense going forward to protect themselves. That the free rider element that they've taken in terms of not having to invest in defense, knowing that the U.S. was going to be there, is over. And that's powerful both in terms of the countries, but also companies. And I think Europe's far more focused on being competitive today than it has been. And when I think about just kind of the differentiation, I still think the U.S. is exceptional. I think relative to the rest of the world, I think the rest of the world is starting to catch up. So I think the next 10 years or 5 years are going to be a really challenging and interesting time in the market. I do think a lot of it's going to come down to what ends up happening with artificial intelligence and how that really flows through to the rest of the market.
Great, thank you, John. So Sam, I want to get into this a little bit more in more detail. And on the multi-asset team, you have tactical allocations that you employ from the solutions that you're creating. I'm just curious where you're positioned today. Maybe you can go down a little bit more detail and tell us what kind of tactical bets you're all partaking in that team.
Sure, so happy to. So maybe I'll just level set a little bit in terms of who we are in terms of multi-asset at T. Rowe. So multi-asset at T. Rowe, we manage about $600 billion of the firm's assets, so it's about a third of the firm. We manage assets across targeting strategies within retirement portfolios, retirement income, We manage wealth model portfolios within the the U.S. intermediary wealth channel, and then hedge strategies and other sort of outcome-oriented portfolios. Our philosophy really across all of these portfolios is very much the same. We're looking to provide durable excess returns across market cycles. And our goal there, really, sort of the implementation is through having multiple sources of value add within our portfolios. We don't want to be overly reliant on any sort of specific market environment to be successful, right? So I think that starts for us with a strategic asset allocation that is sort of robust across the maximum opportunities set per the mandate to not only take advantage of the return opportunity, but also sort of disperse and mitigate risk. We're very fortunate to work with folks like John, so we complement that strategic asset allocation with bottom-up security selection. And then third, our tactical asset allocation process. And I do sort of say our tactical process intentionally third, as I very much see it as a complement to those other components, right? It's an opportunity to tilt the portfolio into areas of opportunity. We're typically looking over sort of a 6 to 18 month time horizon, but perhaps less appreciated, also an opportunity to tilt the portfolio away from risks. So sometimes tactical can really be about risk management. So I think that's important context when we think about our tactical positioning today. We've already talked about some of the challenges we're facing right now. And it is an environment where someone could give you a bull case, someone else could give you a bear case, and there'd be a lot of rational to both sides of the story, right? I mean, potentially getting rate cuts in the US, the AI story might come through, we might have supported fiscal policy on one side, but on the other side, as John said, valuations, especially in equity markets, are very full. We have very tight spreads in the plus fixed income area, and again, it just really feels as though the degree of difficulty is getting pretty high. So bringing this sort of full circle to our tactical positioning, right now, I think balanced is the word. So at a high level, we're equal weight between equities, fixed income, carrying a little bit of extra cash right now, shortening our duration on the bond side. But as you go under the hood, it does become a little bit more dynamic. So within equities, we're slightly overweight actually non-US equity, but we're looking for areas with cyclical upside, right? So we want valuation and a catalyst. So John mentioned European banks, right? So we're overweight international value. You're seeing more deregulation there. We're seeing that fiscal spend, right? They don't have as robust of a private debt infrastructure in Europe, right? So a lot of that is going through the banks. AI applications potentially starting in European banks as well, becoming a little bit more forward thinking. And so while that story has been playing out, we still believe there's room for that to continue to grow. I think international small cap is another interesting area. They don't face as many of the structural sort of headwinds that US small does. There isn't as much private equity sort of ownership there. The fundamentals are stronger, more geared to the domestic economy. And if you think about potential dollar weakness, unlike some of their large cap peers that might be more sort of exposed to global trade, they can benefit from that currency translation without taking a hit to their revenue. So overweight value, overweight small cap, and then increasingly constructive on emerging markets as well, right? So you have valuation there. We're seeing a pickup in global PMI, which is usually a leading indicator. And then China's becoming a little bit more constructive of the story as well, right? They're sort of pivot more supporting the tech story there, a bit of a shift in policy. We're also overweight real assets right now, which we consider as a component of our equity portfolio, so positioning against the risk of increased inflation. And if we look at a lot of the policy, it's hard not to say that there is going to be the potential for pressure in terms of inflation, and we can get into inflation dynamics throughout the conversation. If you talk to our energy team too, while it's been a tough time for energy right now, as we look out into mid-2026, their view is that we should be, or could be, entering a secular bull in terms of energy prices as the US becomes more of a high cost producer, right? We're starting to go down to that tier 2, tier 3 rock when you think about shale. So that's the equity side of the big picture. I'm sure John will have a lot more to say there as well. Within fixed income, I mentioned being short duration. We've seen big running rates. The Fed is cutting, but it does feel like the long end of the curve has been hijacked a little bit by fiscal policy, concerns around Fed independence, and again, that potential upward pressure from inflation. As you go within fixed income, we've been overweight plus fixed income sectors like high yield. It's been a good carry trade. At this point, spreads are very tight. The composition of that index has changed a lot though, right? So I think if you look at high yield bond, double B, exposure from about 2005, 2007 to now, it's about doubled from 30% to 60%. So it is a different index, and there's probably potentially a little bit more room that spreads could compress. But I'd be remiss not to say that I'm starting to feel as though there might be other better opportunities to place risk. So in some of our portfolios, where we also include strategies that do equity option writing. And we can harvest maybe a 9% yield over there, so we're diversified there. I know we've also, in more traditional portfolios, tilted more towards emerging market debt recently, EM local, as opportunities again to sort of diversify that spread risk. So there are opportunities, these are portfolio tilts again, but it's become at a high level much more of a balanced picture for us as we look out over at least the sort of next 6 to 18 months time horizon. Stop there.
Thank you, Sam. That's interesting. And John, I'm going to come to you, but I just want to note to everybody that John's getting over a cold, so he's toughing it out here for us. John, I mentioned at the beginning of my introduction, you sit on our asset allocation committee, and Sam talked about our multi-asset team as being one of the bigger parts of our organization. So John sits on a committee that helps determine tactical allocation for our retirement date products. And you're also a value investor. So you have those two hats that you wear, asset allocation and as a value investor. So try to wear those two hats and tell me how you think about allocating across regions with those two hats on.
Sure, maybe I'll start with asset allocation committee, and Sam talked about a lot of the tilts that we have right now. The asset allocation committee meets once a month. It's comprised of a number of the senior investors at T. Rowe. It spans geographies, so we have investors in the US, outside the US. It spans asset class, we have equity, fixed income as well. And what we're really trying to do is just get a variety of different insights and get people into a room and really have a very fulsome discussion about what they're seeing in the market, and then from that really make some determinations as to what the tilt should be. Sam mentioned right now that we're more neutral than we probably have been in a while, and a lot of that's just a recognition of kind of, if you listen to Sam and I and our answer to the first question, there's a lot we don't know right now, and there's a lot, I think, of variability in the marketplace, which means there's a lot of risk. And as a result, we want to be thoughtful about the risks that we're taking. In terms of kind of the discussions themselves, first of all, the way the committee will work is we really need to get to a supermajority in order to affect a tilt. But more importantly, what we're doing is we're bringing in people from a variety of different perspectives, and we're really trying to offer those perspectives. I think oftentimes we'll start with valuation, which is something we can all agree to. But then we'll also start talking about the fundamentals and having really extraordinary growth investors in the room that really can talk about just how important AI could be for the markets and for the economy over time. Listening to our fixed income brethren talk about just the role that inflation is playing on the fixed income markets, concerns around the US deficit and what that can mean longer term. We also have a number of our equity portfolio managers that will talk about what they're seeing and hearing from their portfolio companies. And we found that that's also a unique set of insights that we can bring to the table. So what we're trying to do is assess both return and risk, a very healthy debate. I think we all recognize the fundamentals, we all recognize the valuation, but the other conversations really occur around kind of sentiment. Is this a crowded trade? Is it not a crowded trade? Where are we different than the marketplace? And then the last thing is we're trying to look around corners. So if we talk about, some mentioned, as the US combats inflation, at the same time that the Fed loses some of its independence, what does that mean for the fixed income market and the yield curve? I think the obvious answer is most likely the yield curve is going to steepen. But at the same time, you're starting to hear some talk from the Trump administration in Washington about potential yield curve control, and what does that mean for the market? What does that mean for currency? I think one of the indirect results of that would be a weaker dollar if that occurred. So we're trying to look around corners and then come up and really take everything we're learning and devolve it down into a series of portfolio tilts. I think over time we've been structurally long high yield as an example, and really taking advantage of the carry trade. But we'll have very vigorous discussion around what we're seeing, if we're talking to our banks, if we're talking to other companies about where we are in the credit cycle, talking to fixed income. And as a result, I think we come to fairly informed decisions, but they're very collaborative in nature. That I think really speaks to the power of T. Rowe, where you have a lot of collaboration, the ability to get a lot of really thoughtful people into the room and try and hash out what are some really difficult decisions. At the asset allocation committee level, as a result, we're more top down in how we're thinking about things. If I now pivot, you asked about equity income and kind of how I invest in general and think about regions. Typically, all our portfolios at T. Rowe on the equity side, we invest on a bottom-up basis. And we really want to understand the story for the companies and then make investments per se. So when I think about regions and opportunities outside the US, I'm really thinking about more at the individual stock level than I am, hey, is Europe a good place to invest? And what we're seeing right now is, last year, about a year ago, we were almost max overweight our OUS sleeve in the portfolio. And a lot of it is just a function of, if you look outside the US, valuations are more compelling than they are in the US. And at the same time, you can make an argument fundamentals are getting stronger. So what we try and do is we'll invest in companies that are global in nature. If you think about ExxonMobil, ExxonMobil does not truly compete with Devon Energy in Oklahoma City, but it does compete with Royal Dutch Shell in London and with Total Energy in Paris. So if we're going to look at Exxon, why wouldn't we look at Total as an example? And kind of using Total as a reference, Total's going to have better production growth than Exxon and Chevron. It trades at a 30 to 40% discount. We really like the management team of Total. We think they're differentiated, and we think their portfolio is really an exceptional portfolio. So if I can buy something that I think is almost, if not as good as Exxon or Chevron, and I can buy it at a substantial discount, that to me is a pretty good trade. And we've seen that across the board, those opportunities outside the US, whether it's in autos, whether it's in oil, whether it's in some consumer product companies, and we try to take advantage of that. So as we think about regions on a bottom-up basis, it's much more not the region itself, but more the company. And what we've seen is a lot of times that these valuation opportunities are really reflective of valuation opportunities that are more endemic to the broader market. And we find that those are real opportunities that we can take advantage of over time.
Sam, I want to come back to you, and you mentioned that you're tactically overweight international small cap, and I'm curious if you could expand on that a little bit. If you look, we often have these conversations about equity markets, and we think about just large cap companies, but small caps seem to be an interesting place to look these days. Tell us a little bit more about what you're seeing in opportunities outside the US and small.
Sure, and maybe I'll talk about small cap in general. Yeah, I mean, the conversation for a lot of folks has revolved around large cap. A lot of that has been the performance of US large cap growth and just the large cap sort of complex in general, and small cap has been potentially a bit overlooked. And in the US, there's been a lot of reasons for that, right? There's been these structural challenges to small cap space. I thought an interesting stat I heard the other day was that when Pharma French created their small cap factor, there was 8,000 securities in the US stock market, right? So if you take the Russell 3000, that's only covering about 40% of the universe of stocks back when that factor was created. Today there's about 4,000 stocks, and so with the Russell 3000, you're covering almost 75% of that investable market. So we've really seen a shrinking of the market, and a lot of what we've seen left in US small cap has been higher beta, fundamentals have been weaker, and they're just more levered towards rates and floating debt. So, over the last year or so, just before this presentation, actually, someone showed me a chart which I hadn't seen about decile performance for small cap. And over the last year, we've seen just that top decile, highest beta stocks within US small cap really rip versus the rest of the market, which is so unusual to compare to what you usually see. About 75% of that top decile of small cap stocks are non-earners. So this isn't NVIDIA, Broadcom, Amazon, and those folks. These are sort of very high beta plays. That said, for US small cap, we have recently added back into that space because it is also potentially a bit of a coiled spring, right? It has been overlooked. John mentioned about sentiment, flows. An interesting thought experiment would be, what if 1% of NVIDIA's market cap went into small cap? That would be a big deal, right, in terms of capital flowing into that space. If we do start getting rates falling on the front end, that would again help given sort of the floating rate nature of these securities. So I see a bit more of a tactical play than a long-term structural advantage, but it could still be opportunity within US small cap if done well. Absolutely an area I would say active management is going to be important, right, given kind of the quality of securities that we see there and how many non-earners there are. Non-US small, definitely more constructive there, overweight non-US small. I went through some of this, valuations are more attractive there, less private market ownership, more levered domestically to potential upside there through some of the fiscal spend, rates are lower. in European markets as well, though those stocks also aren't as levered to floating rate debt. So fundamentally, those companies are stronger, and an interesting way of playing is with a weaker dollar story, cyclical upside globally in an area that feels both having, again, sort of a valuation support and a potential catalyst.
John, on that particular topic on small caps, how is the asset allocation committee doing anything different because of what Sam pointed out?
Yeah, we just started leaning back into small cap to some extent, really recognizing the sentiment had gotten really extreme. But there's been a lot of discussion in the committee just about the structural nature of the Russell 2000 group and Russell 2000 index. First of all, if you think about the market cap of Microsoft and NVIDIA, it's almost the same as the Russell 2000. So these companies are almost becoming asset classes in and of themselves. I think we have some real concerns structurally about the Russell 2000 in that, one, as Sam mentioned, the quality of the index has definitely deteriorated over time. About 43% of the companies are negative earners. The leverage that these companies are taking on is really at all-time highs in terms of the index. So it's definitely a lower quality index than it's been in the past. And we're wondering if there's some structural reasons for that. For instance, you've got Sarbanes-Oxley, which really discourages companies from going public unless they have to. And then second, just given the scale, the economies of scale, a number of companies that are going public now that are really good companies aren't going public as small cap companies, but they're going public as mid or large cap companies. So you really lose the value creation of being able to invest in a company as a small cap and getting a 10 times return as they graduate into mid cap and large cap. Our new Horizons product, which has been one of the largest small cap products for quite a long period of time, was one of the early investors and the lead investors in the Walmart IPO back in the early 1970s. In the late 1990s, we went back and looked at, we never sold a share of Walmart during that time. The market cap of our holdings in that stock alone would actually be greater than the actual AUM on the New Horizons strategy, which at that time was over 20 billion. And that really speaks to the power of compounding, which is if you can find these small companies that are really good companies as they compound, you can take advantage of that. I think the worry that we have is those opportunities are far less today than they've been in the past. So the opportunity for that huge 10, 20 times contributor to your performance really isn't as present today. As a result, I think it's structurally changed the nature of the performance of the index.
Thank you, John. And we've talked about AI, we kind of mentioned it throughout this conversation. It's a very important topic. John, I want to stay with you, and let's talk about, from your, wearing the hat of asset allocator, value investor again, what do you see as AI's impact on the market structure, as well as what are the long-term beneficiaries from your standpoint?
Sure. It wouldn't be an investment panel these days if we didn't spend at least 20% of our time talking about AI. So, but it really is a transformative innovation that is going to impact the economy and markets for quite a long period of time. I'm a contrarian value investor, and that's kind of how I think, and I am, unfortunately. But as you think about, John Templeton once made the famous observation, the most dangerous forwards in the market are, this time it's different. But there are times where it's different, and I think the real question is AI one of those times. My sense is for the economy, it is different. And the real question is going to be, is it different for the marketplace? Right now, we think of AI, and if we translate it into its impact on the marketplace, the translation or distillation effect right now is how many GPU orders is NVIDIA going to get? And that's really where we are in today's environment. But for AI to really work, and for these companies to really harness the real opportunity associated with AI, you're going to need to have really robust end use cases. And if I think about right now, you've got all these different AI models out there, Claude, Grok, ChatGPT, Gemini, and my sense is, unlike search, where you have a natural monopoly, where Google really kind of outflanked competitors and created a search engine that once it got going, there was such network externalities to it, it became better and better than all of the peers, that in AI, you're going to have a very vigorous competition. And as a result, I'm not sure you're going to get that one differentiated model. If that's the case, AI becomes a little more commoditized. And I think then more of the value associated with AI accrues to those companies that are delivering the use case and those companies that are actually using it. And if we think about it, and I will make a case for value now, which is a lot of the AI end use cases are going to center around companies that make things or do things in a very complex regulatory environment. Those are typically value companies. So if we think about financial institutions and banks, there's tremendous cost to be had in terms of cutting regulatory filings. We just met with AIG in New York. You know, AIG has been a very early adopter of artificial intelligence. They believe that they only get to about half the claims or half the RFPs that are submitted to them today. They believe with AI they can get to all the RFPs submitted to them, and they can actually increase the effectiveness of their underwriting at the same time. That's a huge tailwind for AIG. And you see those use cases really replicated across the economy. You know, we met with Southwest yesterday, and they were talking about how they're using AI right now when they have irregular operations at a hub, you know, like Denver, and you've got 20 planes that are on the ground and you have 20 planes coming in. In the past, they've always had like a deli counter where the first plane to come in gets ticket 1, second plane to come in gets ticket 2, and that's how they basically brought planes into the fold. So as one plane leaves the gate, whoever's got ticket number 1 goes into the gate. Using AI, they can look across the system, realize what crews need to get to what planes, that if they bring in that first airline, it isn't helping things because maybe the crew for that airline that's on ticket 1 is on ticket number 10. And so then they come in, they have to wait for people to come in, and it creates a lot of inefficiency. And they found that they can save millions of dollars by employing AI to more streamline their ability to just manage that one irregular operation. And if you start compounding that across a variety of different instances, there's a really compelling opportunity. What it means, however, though, is over time, look, everything's going to get competed away to some extent. What we do think it means is that those companies that can leverage scale and harness scale are going to be positively advantaged. And what we're trying to do is find those companies that we think, one, have an early mover advantage in AI, such as AIG. Second, have the economies of scale to really leverage AI. And then third, have the opportunity, given the market that they're in, to harness it. So over time, you know, right now, a lot of the discussion around AI revolves around kind of what it means to the current situation with GPUs or software, et cetera. I think over time, it's going to be far more balanced. And if that's the case, I think you can make a really robust case for value going forward.
Thank you. It's interesting, John. I think it's consistent with what Sam said before about having ways to play defensively in the U.S. against, and also offensively against AI. So something I've noticed over the last couple of years as a value specialist is that value is working everywhere in the world except for the U.S. And I'm just curious what both of you think about that, and like, why is that happening, number one, and does that create a case for value? I know John's given us some of that case already, but does it create a case for value in the States?
Sure, so maybe I can start here and then John can build on it. I say first of all, I thought your opening comments were really important, that when you look at things from an absolute return basis, we've had strong returns across the globe in the last 10 years, right? So I don't think it's necessary that value in the US hasn't worked. If you look at the annualized trailing 10-year return for the Russell 1000 value, it's 10%. I mean, if I compare that to our long-term CMAs of around 9% for equities, any of us probably 10 years ago would have said, oh, you can guarantee me 10% annualized over the next 10 years, I'll take that hands down. When we look at non-US markets as well, most major markets have been around 8% or so over that time period. The challenge has been, the challenge, I guess, quote unquote, for value investors has been that the US large cap growth index has done 18% over that time period. But again, put in context, the Russell 1000 value has been the second best performing major market in the world over the last 10 years. So, I mean, I think the heart of Caleb's question is, in non-US markets, we have been seeing value outperforming large cap growth. In the US markets, we haven't seen that same thing. And I think, again, rebasing sort of like that 10% return, it's actually pretty impressive that value's been able to do that. I think about sort of how low, zero interest rates, right? I mean, money was free in the States for a very long time, and it's hard for valuation to really matter in that type of a circumstance. I mean, I think about the housing market. I'm like one of those unlucky people that get caught in that craze. Everyone, interest rates were super low, everyone was going in, and then I ended up overpaying for a house that now I have buckets all over the place, right? Because the FOMO that sort of has followed that. I'm literally scared to look up and walk around my house these days. So we've had ultra short low rates, and then we've had the AI story, right? And so John spoke about this, but I mean, if you think about US large cap growth, again, as I mentioned, that's NVIDIA, that's Amazon, that's Broadcom, and those companies don't exist in the non-US market, sort of, at least not to that extent. So we've had this gap. So how can value start working? I mean, I think a steepening yield curve would be helpful to value. Acceleration in economic growth would be helpful to value, and our case is for a steepening yield curve going forward. I think John made a very sort of elegant case for the benefits of AI potentially sort of, again, migrating across into those value companies, which are probably really ripe for AI application to actually have an impact on their bottom line. It could also be such that valuations have just gone so far ahead of themselves, especially for some of these AI stocks that are really priced to perfection, that any sort of wobble in that story could create volatility in the market, less accrual of capital gain for those companies, and value starts outperforming. Maybe that sounds a little bit more tactical, but on a relative basis, just on valuation. So again, I mean, if I go back to my opening comments, I think this is a really important time for balance, and there's always sort of this temptation to chase momentum, but there are a lot of factors right now, some of which are underappreciated, that could provide a tailwind for value investing going forward. And unlike John, I'm not a value investor. I've actually been much more tilted towards the growth story. This has been more of a recent phenomenon for me.
I need to take you to my client meetings. I think there's several other things I just add on. I agree with a lot of what Sam said. Excuse me. One, the international value indices are more financials than they are in the U.S. European defense has worked extraordinarily well given the situation with Ukraine. So I think there's some specific reasons for it. I think the lack of AI is also another really important point to mention. And then lastly, some of the returns, especially in the last 9 months, have been currency related. So the stocks themselves have done well, but they really haven't been that differentiated relative to the U.S. It's been more the currency when you look at Europe as an example. And I think right now that's just a reflection of the fact that the dollar's been really weak, and I think there's still a belief that the dollar will stay weaker. If we start cutting rates, that's clearly going to put some pressure on the dollar. But U.S. I think has been attractive, but as Sam said, the AI play I think dwarfs U.S. value, and outside the U.S. you don't have that play, and you've got more of the indices and sectors that I think are really advantaged right now going forward outside the U.S.
One more question for the panelists, but we want to take questions from you also. Think about what you want to ask John and Sam. And this question is really more about getting beneath some of the things we've talked about. Where are we actually seeing value in the U.S. and in international markets, and what sectors look interesting? And Sam, I'll start with you. Any sectors that you would highlight that are particularly interesting in international equities right now?
Yes, I know I sound like a broken record, but this is a very difficult question, I think. So over the next sort of 5-year time period, if it was shorter, I would say financials. I think that story still has room to run if we're seeing that over the next 1-2 years, right? And for a lot of the reasons we've already spoken about up here. Over a 5-year period, sort of need to look elsewhere. So one, that's come up, and preparing for this question, I really tried to speak to as many folks as I could across our international space, was healthcare, right? So healthcare has been super beat up, but if you look at the pharma pipeline, it's still pretty strong. Perhaps some of the narrative around sort of the administration of states in terms of the downward pressure they're going to put on drug pricing might be a little bit sort of overpriced in that marketplace. And we are seeing a lot of innovation, right? GLP-1s, maybe that's gone too far, but there is innovation in AI. I mean, I remember one innovation in healthcare. One sell-side analyst, I mean, I'm just kidding. It's like just the very fact that the first thing your doctor hands you when you go into the office is a clipboard gives you a sense of how much room there is for sort of disruption within the healthcare space. So healthcare is one of them, and then the other one I'll say is actually technology in non-US, right? So if there's an arms race going on in the US right now, the arms dealers are really the non-US companies. So if you think about Taiwan Semi, ASML, Tokyo Electron, a lot of these companies are delivering, they really win no matter who wins that race, and their valuations arguably are sort of less egregious based on the trajectory of the potential for AI, but obviously all the caveats that John said. So a tough time horizon to pick a sector, but I do think there's a case for healthcare. It's something we've been adding in sort of the model portfolios we manage. It's been dedicated healthcare exposure recently, and then potentially non-US technology as well.
John, anything in the US you highlight?
Yeah, two areas I think are interesting. One would be financials, and a lot of that's just a function of, I remember when I first started off in markets, there's an old saying, "Don't fight the Fed," and I think that was very apropos back in the 80s and 90s. Right now, I think the corollary would be, "Don't fight the administration," and whatever the administration wants to accomplish, they're going to accomplish. And clearly, deregulation is really first and foremost for this administration. And also, I think, kind of a more commonsensical approach to capital requirements for banks is clearly front and center. I think, unfortunately, under the previous administration, banks were somewhat viewed as a boogeyman, and there was no regulation that was enough. And I think right now you're seeing the opposite of that, and the banks are clearly going to be advantaged. We met recently with Fifth Third, and it's interesting once Trump was elected, it's almost like you had these bank CEOs that really couldn't talk bad about the administration while they were in power, that almost were coming out and just going, "I can't believe what the last 4 years has been like." And the CEO of Fifth Third mentioned that in 2023, there were 1,100 new regulations that were imposed upon Fifth Third over the course of the year that they had to respond to. And a lot of them were just really extraneous in nature. But if you think about the compliance costs associated with that, it's enormous. So I think there's a multi-year story to be had in financials. On top of that, if we do get a steeper yield curve, if you see rates stay higher for longer, that's all really positive on a macro setup for financials. The other sector, and it's probably more longer term, I'm not quite sure what the next 6 months will hold, is energy. What you're seeing right now is the Saudis are clearly flooding the market. But at the same time, there are two kind of countervailing forces at play. One, the cost of drilling in the U.S., in essence, the cost curve is rising. Productivity of U.S. shale is decreasing, which means that over time, the marginal cost of producing a U.S. barrel is increasing. The second is spare capacity for OPEC is decreasing. If the Saudis are producing more of it, it means that they have less going forward. And as a result, you're going to see markets tighten in terms of spare capacity. And then lastly, lower oil prices means less activity. And one of the things people forget is if you look at current oil production, let's just say, roughly speaking, it's 100 million barrels a day. The decline curve on that 100 million barrels a day is about 7%. So next year, just to break even, we have to find 7 million barrels a day of oil. And that is going to become a more and more challenging feat, especially for lower prices. So when we look longer term, we think there's a pretty attractive setup in oil. I wouldn't be surprised if oil prices go down from here, but if they do, I would be opportunistic and really look at that as a sector to lean into. And then on top of it, from a valuation perspective, you've got companies that are trading at really interesting valuations and are being really thoughtful about capital allocation. So I can't tell you what the next 6 months looks like, but I can say over the next several years, I think there's a really attractive setup emerging in energy.
Thanks, John. Thanks, Sam. But we'd love to hear from everybody here. So any questions? Let's start over here.
So if the Russell 2000 is no longer a quality index, is there a screen on that or a substitute? Is the MDY mid-cap better? The thing in the Russell 2000 is any small company that's worth a lot more is taken private in this market, right? So is there a better answer than the Russell 2000?
I don't have a great answer. I mean, I do think thinking about it as mid, not small cap, makes a lot of sense. I think we're starting to gear ourselves more and more to that, and thinking a little bit more tactically between small and mid even is something that we've been doing more and more of. I mean, I go back to, I think active management matters, right, in that space. I mean, I don't want to offend anyone running a Russell 2000 index fund, but to your point, I mean, the quality is low, it's high beta, and so you need someone to either parse through that intentionally, or I think broaden the potential universe out to small and mid cap as well. So in a lot of our portfolios, we do think large, mid, small, and a lot of times now we're just thinking SMID.
So I want to thank you for being here, and thank you, Rowe Price. And I agree with the diversification strategy. There are 3 areas, though, that you didn't touch on yet, and I'm just wondering if you wouldn't mind. The first would be, and this is more for institutional investors rather than individual, but I know you have OHA, Oak Hill, in your quiver. So if you could talk a little about private credit, and then I know you had a relationship with Goldman that was announced recently. If you could kind of talk about how you see that weaving in, and then the third would be Bitcoin or crypto, and what your firm's opinion is on that.
I'll try to take them. OHA is, we made an investment in OHA and bought it, and we really run it as a separate entity. We try and have some insights that are traded among the different firms, but really is separate. There's been a lot of debate, I think, internally at TIRA about the role of private credit, what it means going forward. There's a lot of capital that's gone into that sector, and we want to be very cognizant of that. My sense is if there is a credit cycle going forward, private credit is probably on the front lines of how that's going to be impacted. A lot of it's going to come down to underwriting standards. I know OHA does an exceptional job of that, and they're fairly conservative. But at the same time, you do worry about any asset class where you see a lot of money chasing current returns, and that's clearly the case in private credit. I think over time we feel it'll be a good investment for us. I think it's allowed us a perspective for us to think about different other alternative vehicles and alternative investments, which really is kind of a good segue to the Goldman partnership. And I think what we've recognized, and you're hearing it again, don't fight the administration, is there's clearly a drumbeat for including alternative investments and private investments in 401k plans and retirement plans. We have a very vibrant and robust target date offering, and we want to make sure that we're providing our clients with the solutions that they need in order to affect their retirement solutions. As we think about that, we don't have the capabilities right now beyond OHA of offering to our clients, a really robust set of alternative investment opportunities. By partnering with Goldman, they do bring a lot of that expertise to the table. We have expertise we can bring to the table in terms of our target date franchise themselves. And it's a partnership that really, I think, has a lot of merit and opportunity going forward. Our current target date funds are not going to become Goldman TIRA target date funds, but rather it's more an opportunity for us to do something jointly going forward. I think for our firm, it really allows us to protect our flank if alternatives become an increasingly important part of the equation. And also, there's some technology that Goldman has around model portfolios and our ability to service our institutional clients with a variety of different products that we can, in essence, fast forward by being able to use. So we think of it as a very attractive opportunity. Goldman's a preeminent firm out there, and we're excited about what this can mean. I don't know if it's going to be a really big partnership for us, or whether it's going to be something that's more niche, and I think the marketplace is going to tell that over time. In terms of crypto, Sama, feel free to add in. I'm probably the last person to ask about this, but I really struggle with crypto in that in a lot of ways it's what people believe the value of something to be. And I think about Buffett's old observation, if you melted all the gold in the world And then you think about what it's worth, and then compare it to the market value of all these companies out there. There's something to be said for that. I'm not sure crypto will be a store of wealth the way that gold's been in the past, but a lot of it's, it's a function of what the market believes the value to be rather than what the actuality of the value is. And that gives me some pause. But at the same time, what gives me pause is there's some really thoughtful, bright people, even within our firm, that are very big advocates and zealots for crypto, and I want to be respectful of that at the same time.
Yeah, I mean, so on Goldman Sachs, we do a lot of work together with that team. I think we're very complementary, and as John mentioned, there's an opportunity to work together to try to deliver, I would say, sort of full capital markets to our clients, right, across both public and private. With a firm who's been sort of world class at private, right, and we have the active management and the public market exposure. So it is retirement, it's wealth management solutions, it's going to be products that are developed together as well. And I would say the two teams work together very, very well based on my experience so far. Yeah, I don't have a ton more to add on crypto. We have some experts at the firm, we're very bullish on it. Their view is that it is becoming more institutional. They spoke about things that I don't know, about like the halvening that happens with Bitcoin every 4 years, and how that is becoming less and less of an event, and that's a sign of the institutionalization of some of this. Challenges to the US dollar, we've seen it with gold, as Bitcoin starts to benefit from that. But it's speculative for me to sort of opine on that. I am not an expert.
Peter Thiel said that innovation has collapsed. So if you disagree with that, which industry sector do you see innovation?
Can you repeat that?
Peter Thiel, he said that he believes innovation has collapsed in the U.S. It's declined since the 70s. So if you disagree with, I don't know whether you agree or disagree, but if you disagree, where do you see the innovation coming in by industry sector?
I would disagree with that, and a lot. If you look at some of the productivity measures out there, that would argue for his argument. I worry a little bit about some of those measurements and whether they properly reflect the innovation of the economy. Sam mentioned healthcare as an example where I think there's a great deal of innovation. GLP-1s, I think, have been a real game changer, and I think that will continue to be the case. And the problem is we're really in the early stages. We know that the innovation's there. If you talk to people that take, I was sitting next to a colleague that took GLP-1s, lost 60 pounds, is incredibly far more healthy. Those use cases are out there, but they're not so prevalent in society today that you're going to see it reflected in measurement or statistics. And I think that's one of the challenging things for the markets today is we see the innovation, but it hasn't shown up yet. So you see valuation spreads that reflect that innovation, even though it hasn't happened. So you see valuations blow out. I am a believer that AI is going to really transform our economy. And again, we're in the early stages of this. We're trying to prove it out. But for any of those people who've used AI, there's an exceptionality to a lot of what it can accomplish, and it's just continuing to get better. I wish I had had AI when I was in college. It would have helped me a lot. But I think, if you took a snapshot of where we are today, I think you could argue his case. But I think for you to argue his case in the future really, I think, suggests that the innovations that we're seeing today that we really do believe in aren't going to come to fruition. And I'm very confident taking the other side of that.
I guess I don't have a ton to add there, but it is interesting how some of these innovations get captured in, as John was saying, sort of like the economy versus financial markets. I mean, even think about something like YouTube, right? I mean, it used to be your bike broke, you take it to the bike shop, right? Now you watch a video and you fix your bike. So a lot of these things are happening and adding real value to people's day-to-day lives and are innovation that might not always show up in kind of like top line numbers in different places. So I'm taking the other side too.
There are two topics that are related to what you spoke about. Just wondering what your thoughts on it currently. Japan as an investment opportunity or not, and the data centers thing related to AI and the build out of that infrastructure.
Yeah, so maybe I can start with Japan. So, Japan's been an interesting case. We've been overweight Japan in a lot of our portfolios recently. In some of our portfolios, the asset allocation committees brought that in. We have some where we're still sitting overweight. Japan's interesting. I mean, they're at the front line of a lot of the AI themes too, right? I mean, if we think about the application of AI in manufacturing, that's going to require robotics, and that's the place that Japan's very advanced on. You're seeing sort of a slow shift in sort of the governance model, or sort of corporate reform, right? That has been very sort of additive as well. So I do see a longer term case for Japan. Tactically, probably see better opportunities elsewhere at this moment, but if some of these themes we've been talking about come through, it's a tremendous upside opportunity for Japan as well.
In terms of the data centers, to a large extent now the gating factor on kind of AI innovation becomes your ability to access power. And GPUs are just power hogs in terms of the amount of electricity it takes to power them. I don't know if we've seen a bubble, but you've clearly seen a tremendous amount of speculation, future ordering, and people really trying to set themselves up for securing the access to power or thinking about data centers in the context of that. And you've seen almost a bifurcation in the market where the market's going to give a very hefty premium to the companies like Vernova that have turbines and can really profit from it. At some point, we're going to get an overbuild there. I'm not quite sure when that is going to be, but I know that's increasingly becoming a conversation. I just met with Hugh Johnston, who's the CFO of Disney, and he's on the board of Microsoft, and he was mentioning that they spent over an hour at their last board meeting talking about, are we at the point where it's a bubble and you're seeing a lot of overspend and overbuild? I think like any innovation, when people get really enthused about it, you typically do see overbuild and overspend occur. I think that we can accept as a fact. I think the question is going to be, where are we in that stage? Are we in the third inning, in which case there's still a lot more value to be created from the build? Are we in the seventh or eighth inning? I think the other way, as a value investors, I think there's some pretty interesting ways of playing this today. If you think about some of the utilities that are out there, and actually the Ural's utility, Southern Company, I think is really well positioned given the regulatory construct, where they're able to pass on the full cost of building new generation to the new customers, whereas other utilities, they have to pass on the marginal cost. And as a result, the bill and the rate bill for customers is going to increase as they build the generation, whereas here in Atlanta it won't. So, trying to understand the regulatory construct, I think is going to be important. Trying to understand the contracts. Is this a speculative firm that's trying to contract the power, or is this a Google or Microsoft? I think it's going to be important. And I think when you talk to the Googles and Microsofts, they're willing to commit to this because they believe even if they can't use the power for AI at that phase, they can use it for their other part of their hyperscaling business. I think increasingly, and this is John Linehan talking on the value side, we're becoming more and more skeptical about the ability of this to kind of perpetuate itself, but it clearly is front and center in the markets today.
John, I want to ask you a question, and you might not be able to answer it, but you mentioned you like financials now, and one of my personal small financial holdings is T. Rowe. And I'm thinking, at 103 and change, you're like 50% below where you were in 2021, yielding 4.9%. So even with, earnings and revenue growth that's been slowing recently, and you've got OHA, you've got the Goldman partnership, you've got the Trade Target, big funds. Isn't your stock a good buy right now?
Well, to start with, I am right there with you. I want to be careful here because I'm also thinking about our IR department right now is cringing and Baltimore. I think there are a lot of reasons to like this. I think some of the questions also, though, are around markets. Obviously we're a levered play on the market, so if you think markets are going down, it's going to be tough for us to overcome that. If markets are going up, I think we're a beneficiary.
You know, I would say I think it's a more challenging environment for us today than it was 15 or 20 years ago. It's a lot easier to operate when the wind's at your back. And 20 years ago, with the advent and the rise of the 401k plans, the QDIAs, we really were in the sweet spot. And I don't think that's the case today. So I think it's, we've got some headwinds we've got to navigate. I think we're doing a very good job in thoughtfully trying to navigate them, but I don't think it's as compelling a proposition today as maybe it was a long time ago. Counterbalancing that, though, is the valuation today is a lot less than it used to be, and as a result, I think you can make a reasonable argument for us. I think our IR department right now is okay with everything I said, but I probably can't go into more detail than that.
I think we're up at time. I know you all have busy days. I appreciate the time you all gave us today, and thank you to our panelists, Sam and John.